Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover some topics related with depreciation, impairments, and depletion. In this audio, we're going to discuss something about asset impairments. So, what is asset impairments? As long as you have an asset, you always have this risk of having this asset impairments. So, asset impairments refers to the scenario that when the fair value of an asset, it could be short-term asset, it could be long-term asset, that is less than the carrying amount of the asset listed on the book. If this occurs, asset impairments occur. Here, fair value means market value, which is defined as the sum of the expected future net cash flows. Carrying value is the current net book value. An asset impairment could be due to lots of reasons. For example, there's updates in the technology and your old equipment is outdated and the market value of your existing equipment is very low, lower than your book value, then asset impairments of the equipment occurs. It could be due to your abnormal usage that causes the value of this asset decreases. It could be due to any changes in the economic environment that actually causes the asset impairments. So let me give you two examples here. The first example I'm giving is this Corning's Goodwill, this asset impairment. In 2004, we can see that they actually found that certain factors caused the Cornings to lower the estimate and the projections for the long-term revenue growth of their telecommunications segment, and indicate that the fair value of this telecommunications segment reporting unit was less than its carrying value. So this is consistent with our definition of asset impairment. So asset impairment occurs. What they did in this year is they recorded impairment charges of $14-20 million to reduce the carrying value to $117 million. So $14-20 million is recorded as a loss on the income statement of 2004, and the new cost basis for the goodwill decreased to $117 million. Another example comes from Cisco. In April 2001, Cisco system wrote down inventory by $2.25 billion. From the company's April 2001 quarterly report, they reported that the additional excess inventory charges was due to a sudden and significant decrease in forecasted revenue, which means that they found the market demand went down, which means that the market value went down lower than the inventory values on the balance sheet. So that's why they wrote down $2.25 billion. Of course, this charge will negatively affect the income statement, negatively affect the net income, and also will bring down the value of the inventory on the balance sheet. Now, in terms of how to treat this asset impairments on our accounting book, first of all, we need to categorize the asset into two buckets. The first bucket is those assets held for internal usage. For example, your equipment, your building, your property. So for those type of assets, first of all, we're going to calculate carrying value. It equals acquisition cost minus accumulated depreciation. Now we're going to calculate the impairment losses, which equals carrying value minus fair market value. So impairment losses is the excess part of this carrying value over the fair market value. For those losses, we're going to first debit, loss, credit, accumulated depreciation. The loss or impairment goes to the income statement. Accumulated depreciation goes to the balance sheet. After that, all the depreciation expenses should be calculated based on this new lower cost basis. And there should be no changes in new cost basis except for depreciation, amortization, or some additional impairments. The second bucket of assets are those assets held for disposal, for example, inventory. Okay, how to deal with their, for example, inventory's asset impairments. We still need to calculate their carrying value, calculate the impairment losses, make this journal entry, and then calculate the further depreciation expenses based on the new cost basis. Those are exactly the same as we just discussed in the last slide. However, interesting thing is for those assets held for disposal, we could actually write up or write down in the future periods as long as the new carrying value never exceeds the carrying amount of the asset before the impairment. If you remember, for those assets held for usage, we cannot write up. The only thing we could do is keep those cost basis or write down. Okay, we can never write up. So that's the only difference between the asset held for disposal and asset held for usage.